As people know, we started with the hedge book at around 12 million ounces, and that had been a consequence of many years of hedging. So we started around 12 million ounces. Average cost then about $350 an ounce. So we've taken all of those positions out. The actual cash we've had to put into the hedge book is about $6 billion, but the reduction in risk and loss of value was about $10 billion starting at that original number. So we've made about $4 million if we measure it on mark to market today. So it's been very positive, and certainly in terms of future values created at least $4 billion worth of future value based on today's numbers.
Having waited to the $1,300 an ounce level to take out that position, it's got to mean that you're pretty optimistic about that gold price moving forward, because if you were negative, you'd probably be keeping your money in your pocket right now.
Well, yes, we would be, but we've been optimistic for a while. And don't forget, we did the transaction, we took out the hedges over a range of prices, and so the average effective price that we've done it all is at about $970 an ounce. So the last lot of the ounces, which represent about 25% of the total, was done at $1,300, but the average for all of the ounces is around $970. So that's how we get to a $4 billion profit in terms of the transaction.
So let's take the hedge book out of the numbers we're seeing today, because then we would have seen HEPS up 135%. It would have more than doubled, that means, your profits. Is that the kind of pace we should be looking forward to moving forward?
Well, I think that number, actually the doubling or the more than doubling, goes to our earnings a couple of quarters back. So this has been quite a remarkable quarter for a number of reasons. So it's been a very strong quarter. But you're right, if we're at 300, based on that set of quarterly results, we'd be north of $400 million. So that's the sort of sense of the improvement that makes in terms of the hedge book and what it's done to us previously.
Looking at lots of cash generation there. When it comes to capex specifically, I mean, capital spend on an annual basis was somewhere between $1 billion and $1.1 billion, about 700 million of that to sustaining the business, and then 300 into new projects. Are we looking at that kind of dynamic shifting now?
Oh yes, absolutely. If you look at our business, we're trying to grow the business by more than 20% over the next 5 years, so there is some investment required. What we said in our most recent hedge book transactions is that we've got about $2.4 billion to spend over 3 years, which would be about an average of $800 million a year on new projects. So the new project spend goes up by another $500 million. So that's the sort of general dynamic. We won't guide formally until early next year, but that gives you a sense of what shift you'll see in the capital.
Well, you've already said that output for the year would be 4.5 million ounces at a cost of $635 an ounce. So that's compared with your previous forecast of 4.5 million to 4.7 million. So pretty much in line there. What's your outlook and target for 2011?
In 2011, we still won't guide into next year. It will. We believe we'll go forward and start to build our production base, but we haven't yet given formal guidance. So I'm going to keep that one up my sleeve until early next year. But certainly we've been very encouraged. We just still have a couple of challenges up in Ghana and with the slowing of Savuka because of the seismic activity. So yeah, a couple of drawbacks, but overall the company is still going forward, and we believe we've got a great future.